Hello everyone. Assalamu alaikum. I'm Dhananjay Kumar Barmon. I study in computer science and engineering at SUST. Today, I'm going to talk about chapter 7. The name is Money and Banking in our economic course. Chapter plan. The name of chapter is Money and Banking. The chapter is divided into four key sections. First, we have money, where we will explore its definition, evolution, and important functions in the economy. Next, we will discuss the demand for money, which includes transactions demand, precautionary demand, and speculative demand, explaining why individuals and business hold money. Then, we move on to the supply of money, covering its components, the balance sheet of commercial and central banks, the process of money creation, and the concept of money multipliers. Finally, we will examine the money, where we will understand the quantity theory of money, how money market equilibrium is achieved, the function of the central bank, and the relationship between money and economic output. Throughout this chapter, we will gain insights into the role of money and banking in the economy and how they influence financial stability and growth. Money and banking. What is money? The most general definition of money is any good that is widely accepted for purpose of exchange and in the repayment of debts. Money is the foundation of the economy. Money is an essential part of our daily lives. It is not just a means of transaction but also a system of value that helps facilitate trade within an economy. Money forms the foundation of the economy, playing a crucial role in our daily lives. It allows individuals and business to conduct transactions efficiently. How do banks manage the economy effectively? In this presentation, we will discuss the importance of currency and the role of the banking system. What is money? A medium of economic transactions used in the exchange of goods and services. Problem with the barter system. The necessity of matching the wants of both parts, double coincidence of wants. Evolution of money. Metal coins, paper money, plastic money, digital currency. Before the invention of money, people relied on the barter system. However, this system had a major drawback known as the double coincidence of wants, meaning both parts had to have exactly what the other needed at the same time. This made trade complicated and inefficient. To solve the problem, money evolved over time. Initially, metal coins were used, followed by paper money. Later, plastic money such as credit and debit cards became popular. Today, we are moving towards digital currency, which allows instant and seamless transactions worldwide. This evolution has greatly improved the efficiency and convenience of financial transactions in the modern economy. Function of money. Money plays a crucial role in the economy through its four primary functions. First, it acts as a medium of exchange, allowing people to buy and sell goods and services easily without the need for barter. Second, money serves as a unit of account, helping to determine and compare the value of different goods and services in a standard way. Third, it functions as a store of value, meaning that money can be saved and used in the future without losing its worth significantly. Finally, Money is a standard of deferred payment, which means it allows people to make transactions on credit and repay debts in the future. These functions make money an essential component of a well-functioning economy. Transaction demand for money. Transaction demand for money refers to the amount of money that individuals and business hold to carry out their daily transaction. It serves as a medium of exchange, allowing people to pay for goods and service easily. Additionally, it helps in meeting regular financial obligations such as rent, bills, and wages. According to the classical quantity theory of money, transaction demand is influenced by prices and income. As income increases, people tend to spend more, leading to a rise in the demand for money. This highlights the important role of money in maintaining a smooth economic transition in our daily lives. Precautionary, precautionary demand for money. Precautionary demand for money refers to the memory uh, up to the people of money and business hold to cover unexpected expense or emergencies. It acts as a financial safety net, ensuring quick access to funds in situations like medical emergencies, sudden repairs, or unexpected income uh, fluctuations. This type of money holding provides a sense of security and stability, helping individuals and business navigate uncertain financial circumstances. That's why it is often called rainy money, as it prepares us for difficult times when extra cash is needed the most. Speculative demand for money. Speculative demand for money refers to the preference for holding cash or highly liquid assets instead of investing in financial instrument. This demand is preliminary, driven by expectation of future changes in interest rates or assets price. Driven by expectation of future change in interest rates or assets price. By keeping money in liquid form, the aim of to take advantage of better investment condition in the future or avoid potential losses in the volatile markets. Supply of money. The total amount of money available in the economy at a given time. The supply of money refers to the total amount of money available in an economy at a given time. It is determined by the central bank and commercial banks and includes both cash in the circulation and bank deposits. The component of money supply include currency outside banks, the physical cash held by the public, deposits, which are the further categorized into checkable deposits. That means funds that can be withdrawn or demand. Savings deposit, money kept in savings account. Time deposit, funds deposited for a fixed period. Based on these components, the money supply is divided into different measures. M1 narrow money equal currency outside banks plus checkable deposits plus saving deposits. M2 about money M1 plus time deposits. M3 equal M2 plus long term deposits. This classification helps in understanding the liquidity of money in economy, with M1 being the most liquid and M3 representing the broadcast measures of money supply. Balance sheet of COB and CB. Balance sheet is a statement of assets, liabilities, and capital of a business or other organization at a particular point in time, detailing the balance of income and expenditure over the preceding period. Assets: things the business owns or has a claim to, like cash, property, or equipment. Liabilities: what is the business owes to others, like loans, bills, or credit. Owner's equity: the owner's claim to own the business after liabilities are deducted from assets. The balance sheet equation is assets equal liabilities plus owner's equity. Balance sheet of COB: assets, reserves, loans, investment, and securities, others, equal total assets. Liabilities: checkable deposits, savings, and time deposit, others, liabilities, net worth, equal total liabilities. Total assets equal total liabilities, net worth equal assets minus liabilities. Balance sheet of CB: assets, government securities and T-bills, loans and repo, domestic assets, others assets. Liabilities: currency deposits of COB, equity capital, others liabilities. In conclusion, we have learned in the role of money and banking in the German economy. We covered money's function, types of money demand, transaction, precautionary and speculative, and the supply of money, including different classifications like M1, M2, and M3. We also look at balance sheet, understanding how assets, liabilities, and equity relate. These concepts help us understand how money and banking impact economic stability and growth. Thank you for your attention, and I'm open to any question.